Now we're live.
Now we are live.
Now we're
All
live.
right.
Hello, nice.
What's up, Carlos? All
Yeah.
right, let's
So we
start
want to
letting
welcome everybody. Thank you for being in another monthly webinar at the Catholic Breakfast Club. I have a great one for today. We don't have a guest, but we have plenty of information, and also something that we want to do, and we'll be discussing right before we start the webinar. Is that we want to make sure you guys have participated. Let us know where you guys are tuning from. If you have any questions, if you have any comments, so we're gonna say some. A lot of things that we say we're gonna share is our opinion in terms of the topic. So, but we are open as always to find out what you guys are thinking, what is going on in your market. So let's start with the alumni. So are we connecting from? So right now, I'm in Charlotte, North Carolina. How about you, alumni?
I'm in where am I? I'm in Florida. I'm in Florida right now. I'm usually between Virginia and Florida. What up, chat? My son told me to say that. That sounds so weird. What up, chat? We have all right, Juliana coming in from North Carolina as well. All right, real quick before we guys start, guys, put in your location. Love to see who's joining us in today. Welcome, Kim, my team member behind the scenes as well. So we got some pretty cool stuff. We got Eric from Northern Virginia. Welcome. And we're going to cover a little bit of creative financing, a little bit of the economy. If you guys have questions, or there's a lot that's gone on in the last month, we can't cover everything. So if there's something specific that you guys want to cover, each individual club, as you guys know, every once in a while we do what's going on in the economy, open discussion. My club in Ashburn, typically that happens once maybe every other month or so. But this allows us at least once a month to be able to tune in and have a discussion. So if you guys have a question, you can chat it, type it in, or you can raise your hand and we can figure out how to pull you on the video. I think Ken might be able to help us figure that out. But we have Stephen City, Andrea, welcome. We have Zainu from Sterling, welcome. We have Dev from Reston, awesome. Martinsburg, West Virginia. Richmond, what's up, Tanya? Good to see you. We have Andrea. Welcome back. Awesome. All right. So we'll wait for those to come in. So once again, what we are going to cover a little bit of economy and then creative financing. And many of you probably have sat through a creative financing class before, but there's a topic that we have a bullet point on, but we never really go into deep case study on. And I've been doing more and more of these deals, lease options and wraps. And so I got a couple case studies. We'll probably have time for one case study today. So even if you sat through our classes on creative financing, this is likely new for you as well. So excited to share that. All right, brother. So what's going on with you? Let's talk about the economy, and then as you guys have questions, my assistant Kim will keep an eye on it and let us know, and we'll try to answer those as we go.
Yeah, before we start the economy, I got to share a quick story. That was one of my first meetup events here in Charlotte. And then I prepare like all of you guys that run the clubs. That's an amazing behind the scenes operation. So I got the portal, I got everything. So with the economy part, and I make a very intelligent decision to put Mr. President Trump picture. And I was like, what do you think about the economy? And it got really heated. And I think I haven't done it more because I have a microphone. At that time we had two, and it was a wireless. And so Victoria always is my and she's the leader. I'm the co-leader. She leads the club, and then she just give it around to people, and people start like just expressing their opinion. And then we have people on the other side, and I was like, man, it was supposed to be like a 5-10 minutes, and it was really heated. So
one way to take it off the rails, right?
I know. So now this is
right in the middle of it. Yeah, it doesn't matter. It doesn't matter what side of the politics you're on. Economy is the economy. So how do we see the economy? What's going on? How do we interpret it? And more importantly, how are we as investors using this data to make our decisions? We got a bill in Fairfax, a lot of Northern Virginia representing today. Love it. Yeah, no, I agree. So Carlos, you have a slide you want to share and maybe some talking points here? Love it. All right. So what are we looking at? That's a lot. It's a lot. You're an artist. Obviously, you use AI
Yeah.
to help pull this together.
No,
I gotta.
I did it by myself. Well, at different markets. It's something that I always call my attention when we hear about the economy. There's so many conversation, and then a couple of things. First of all, when you hear everything in the news, and even a lot of things that we're gonna mention here is nationwide, the whole country, and as you know. It varies. Like sometimes, like even within the city, you know, if you have different neighborhoods, it varies. So what we're gonna talk about is the different markets that ideally we want to keep an attention because those are giving the indication that how the economy is moving. So one of the first one is inflation. I'm from Colombia. We used to talk about inflation all the time. Since I was little, I was just watching the news. They were worried about inflation all the time. I never heard people talk about inflation here in the United States until recently. And the reason why is because we were stated like around 2%, and it was ideal. And then it went to like close to 9, and a lot of people think it went higher to the double digits, 11, 12%, and some people say it was even higher, but it was just it was not reporting correctly. So that's one of the first one that we want to pay attention. It's improving, obviously, and that makes, and we mentioned that because a lot of decisions that are make or are not being making is based on that. For example, the rates. The Fed, a lot of people were waiting for the Fed to touch the rates, but inflation hasn't been reached out the limits, which is the threshold that they want, which is 2%. We're still in the fours. So it's better than what it was before, and close to 10%, if not 10 or more. But it was still high that we want to be. That's one of the reasons why the rates still do it the way they are, because they still want to try to bring inflation as much as they can.
Yeah, I mean, I think I checked. We're at 3. It says 3.3. I think we're actually at like 3.4 today. Obviously, that fluctuates with the
Yeah.
CPI, and how we're gauging it is based on that. I remember doing training probably 5-6 years ago when the inflation was 6-7%, even a couple years ago, and thinking we're going to get to that 10% level. Now it's come back down. And it feels somewhat stabilized, which is odd because the market's not really reacting as volatilely as it was. Initially at the beginning of the year, we had so many things going on. They're still going on with Iran, but not a lot of new news, I guess. And so it's holding steady. I would say your average consumer probably still feels it's higher than 3%, right? We're dealing with the inflation that already happened. So although the growth is stabilized closer to 3.5%, we're still dealing with what went up over the last couple of years. So we're feeling it at the pump, we're feeling it at groceries, and so I think your average consumer is not bullish on the economy, or those who don't feel bullish on the economy feel that pinch. Like they didn't get that increase in wages, but the inflation, they're still paying that today. The increase in inflation is going down, but it's still definitely hitting that for sure.
And that's a great point, because a lot of people say, okay, that sounds great, but I'm still paying higher for the groceries and for the cost of the goods of living, more than the last couple of years, and that affects our main topic here, which is real estate. Because people will, we were having this conversation in our podcast a couple of weeks ago, where prices go up, but they don't come down usually. So the milk, whatever it is, the eggs, get to the price, and usually they don't come down. And if the income doesn't grow at the same rate, that's when you have people that say, you know what, right now it is harder, because with the highest rate, high inflation, so it's hard to afford to buy a property. That's why everybody like waiting. Okay, if the rates come down, we're going to talk about that. If it makes sense to wait, or if we can just generate some deals through creative financing, that might be it's a curveball in terms of how can we get into the property and with the better terms that they are facing right now in terms of like just regular rates and the market condition.
Yeah, I was talking to someone just yesterday about economy, the debt. You have something on here we have our national debt, which is going up and up, and it's continued to go up over the last several administrations. It's ballooned drastically, particularly over that COVID period, and since then. And that the debt payments is what we're struggling with, right? And kind of drawing the correlation to us as consumers using debt. So us taking out a loan, and this might go into a different tangent we don't have enough time to deal with, but we are so incentivized to take out loans. The government wants us to take out debt. The government doesn't want us to save money. They want us to take out debt because most people don't know this. When you take out a loan with a bank, in most cases, that money is created once you take out that loan. It's not like they're going to go get it from the vault and give it to you. It's actually created. So how the velocity of money happens in our economy is they find credit-worthy borrowers, hopefully you, to borrow that money to go do something useful with that hopefully gets a return and adds to the economy. But it's not a finite amount of money. It is created. And trying to draw a correlation, it's not exactly the same way, but, when the government spends, unfortunately, they're creating money as well. And it's having an effect to help us hopefully grow our economy. But then the problem is we have those debt payments, just like us as a borrower, we still need to grow something that is profitable, that where we can pay off that loan or at least make the service payments on that loan. And so many things that they're spending money on are unfortunately not leading to enough revenue coming in to be able to service that debt. So right now, a lot of people are, you got two camps. One, we got to cut spending drastically. I don't see a way that we're going to do that. I don't see politicians voting to cut the spending, although that probably is what should happen. It's just almost a death sentence for your political career if you start saying that we're going to spend less. And so that's tough. So really the only hope a lot of people are putting into the hope of growing our economy and obviously using AI to grow at an exponential rate. So our economy grows to basically have the debt to economy growth percentage, separate in difference there. So it's interesting to see what's happening there and then draw that correlation back to us as individual borrowers and investors.
Yeah, and if you like this is general information. So if the general public looking at this, so the government is in the national is in debt. Consumer debt is one of the highest in history meaning credit card and personal debt. Consumer savings is the lowest. So that's why when we're talking multiple times in terms of the K-shaped economy, that's why people are saying it's a horrible situation what is going on right now. But the upper side of the coin, which is the upper side of the K, is people that own assets meaning real estate, businesses, something that produce money, that bring money into their pocket. So that's why it's so important, and we're so thankful for you guys to be part of our club, and obviously for Omni to create it and for create all these tools and information. Because that if we keep playing the game the way everybody's playing it, those are the results. Debt, low savings, and they don't have any assets to try to, like you mentioned. Okay, if I have a loan, I can pay. I have a surplus to be able to reinvest or leverage it. So that's what I think is so important for you guys to be part of the club and obviously take action and all the things that we try to discuss on the monthly basis. And besides that, just have an open mind to whatever we discuss later in terms of the creative finance, because and I think that's one of the biggest things that everybody we were like taught to do things in a certain way, and we will mention the education system may be behind decades. It's not progressing the way the economy is progressing. So or the world is progressing. So that's why it's so important for you guys to, and we don't take it for granted that you'll be here for us and a Friday, and I'm sorry, on Wednesday night to be able to listen to this and realize, okay, this is what's going on. This is how everybody else is seeing it because it's true. How can we react and how can I behave myself in terms of like be a steward of my money and to be able to multiply and obviously multiple vehicles, but the vehicle that we choose and that we think makes more sense is real estate.
Yeah, makes sense. So we got Bill joining us. Welcome, Lucas. Lucas had a coffee meeting with him a couple of weeks ago in Arlington. Welcome. No, you're exactly right. And really from real estate investors, so much of this affects us. But the thing that we care about the most are inflation and interest rates, and those are somewhat tied to each other. And so the question I get, I don't know, at least once a week is, when do we think the rates are going to come down? What are the rates now? We're at high sixes, maybe low sevens or so, depending on owner occupant versus investor purchase. You can obviously buy down that rate, but getting down to the low sixes, high fives, mid fives. What do you think? Put you on the spot, Carlos. When are we getting back there?
Well, if you ask me, I think the rates might go a little bit higher in September when they meet again. And then uh, I do remember, especially in the multifamily world, last 24 months, everybody was saying next year, the beginning of next year. So they said there was going to be by the end of 2025, beginning of 2026, second quarter, third quarter, we're getting into the third and then pretty soon into the fourth quarter, and it's still haven't come down. So I think it's gonna take longer than we expected. I think that it's gonna be. I mean, I don't have a crystal ball, but the way things are moving, and because of these numbers and unemployment and the economy, not reflecting the way it should be, because I mean inflation is going down. I don't see rates come down like in a major way in the less than 12 months or 18 months. That's what I think. I don't know. How about
Hmm.
you?
Let's pull the group. What's up, chat?
Yes.
So let's see. When are we gonna get a natural, like a five handle, like an interest rate with five in it, even if it's high fives, right? So we're passing the sixes. We're talking about five, five and a half, 5.75. What month or maybe what year, if you think it's not this year, do you think that's going to happen, or you think that's even going to happen? Right? Put in the chat what your thoughts are. When do we think? How bullish are you on things stabilizing and those rates potentially coming down again? Right? A lot of things need to happen. So interested to see what some of those responses are. But let's
Yeah,
shift in. Go ahead.
in the meantime, we share. I think that was last month, or the month prior, the graphic for the last 100 years. In reality, if you see, I mean, just in the 80s, there was like 18% rates. This might be the new norm. I mean, it might not even come down. I mean, obviously, we want them to come down, and I think that everybody else in the government and is going to try to do their best effort to make it come down because prices are too high. I mean, and higher than what the 80s prices were. But anyway, so you said, and again, this is your part. This is your participation. And if you can put in the chat, what do you think the rates will go in the fives?
Yeah, part of the conversation I was having the other day with somebody is, all right, we think back into the 90s. The 90s, the rates were, in between 6 and 8% or so,
Yeah,
and that was stabilized. And the 90s was a booming economy. It was like, and so why can't we have that booming economy with with our current rates today, right? And for some people, it's you guys are crushing it, but many people feel like, okay, it needs to lower to help stimulate, growth, help stimulate more investments and things like that. But if you think about where the 90s were, the 90s came off of the 80s where you're at 16 to 18% rates.
yep.
And so relative to where we came from the 80s of so long of being such high rates of 15, 16, 17, 18% rates, and getting into the 90s, at a 8% rate, that was such a big difference. People felt like, man, this is a time. And so they used it, and it was really cheap money compared to the previous decade. Where we're in the exact opposite. We were at 0%, 2%, 3% rates for so long. And then we go up to 7, 8, 9% rates, same as in the 90s. However, just a shock factor of what we've been used to. So I guess we were spoiled for almost a decade with our
And
rates.
also, yeah, that could be it. And at the same time, my opinion is that we have so many more dollars in the market now than what we had in the 1980s. I mean, so many more money were print. So yes, so the dollar, and you did an amazing explanation a couple months ago. The dollar lost so much value because $1 in 1980, 1990 was a lot more than what the dollar it is right now. So I think what someone was saying, like, just to get into Disney was like, I don't know, 12, $15. And now I think it's 80 or 90, even 100. If you want to get one of those easy passes, even higher. So I think that's what it is. So the reason is that yes, the rates were like almost at the same level, but the dollar was worth more because there were less of them.
Yeah,
Especially after the pandemic, when we print so much money. I think that's one of the reasons that everything became so much. I mean, it's good for us that we have assets because they went up in value, and we look like the geniuses. Oh my God, this is great! So now we make all this money. But realistic. Is that I think that's my answer. But I would like to know everybody else. We have an answer from Bill.
So
Maybe
he
a big rate
feels,
drop.
yeah, right before an election, a rate drop and fall. Sometimes we see that. That might be, various moves being made to make the economy feel good prior to an election. Sometimes there's some manipulation there. Jose Marin feel, what was that? I saw it come on 2028. Yep. Okay. 2028 current events may push it out even further. Carlisle. Yeah. So some people are hoping for 2027. I think it might get pushed out even further. I a couple of years ago was thinking we might get up to 10%. I've said that a couple of times, and obviously there's so many things that would get in the way of that, but you never know. Lucas, what do we got from Lucas? Stock market crashing soon due to AI expansion. Man, you are reading my mind, man. I don't know if we had that discussion. Next week we'll probably chat about that. The balloon that I think we're in next month. I brought in a presenter to my Loudon Club last month, or maybe the month before that. And we talked about this, what I'm doing differently specifically around this topic. So I'm working with him to see if he can come on our webinar so that everyone can benefit and participate in that as well. But yeah, there's so many factors. Obviously, it's a fluid scenario, but what you care about as an investor is when can you get a decent enough rate, or if you're sitting on a property, and when are you going to refinance? I've got some burrs that I paused midway and a couple years in, like, all right, these are just rentals now. I'm keeping more capital in those deals than I normally would because, I don't want to refinance at a 7.5% or an 8% rate. At some point, you just might have to, like, all right, I got to get that capital back. The cash flow is going to suck on that. However, it makes more sense for me to get that capital back to go do more deals.
And that's another thing. I'm like, that's a great point in terms of, okay, if the rates come down, what will happen? A lot of people will qualify for loans. A lot more offers. Right now, like it's a buyer's market in most of the country. So it's more inventory, less buyers, more opportunity for buyers to negotiate. If the rates come down, usually what happens, we have a wave of new buyers. Then now we'll qualify, and the price will go even higher. So that's why when we mention, like, just buy the house, don't marry the house, don't marry the rate. So sometimes, and we know people, and I think that's the question we have later. Are you going to wait until the rates come down to buy properties? And the answer might not make sense, because at that point you will have more competition and the price will be going to be higher. Yes, at a lower rate, but you continue paying higher prices.
Yeah, Bill had an interesting comment. Talks about redoing the FICO credit score altogether and changing how we qualify for loans. There's been talks on that. I don't know how far along they are and how realistic that is to see that soon, but a lot of people discussing that as well. Victoria, when rates come down, prices go up. You are correct. Yes, we're waiting for the rates to come down. Don't wait to buy for the rates to come down, but you might be waiting to reposition or change your financing at that point. Still buy, always buy. We'll talk about that today, what I'm doing to buy even in high interest rate environments, because you wait for the rate to come down 1% or 2%, but now that spiked the prices, and now your average price is up by 5, 10, 15%. Because there's so many buyers that are just waiting right now, right? We are not buyers that are waiting. We're always taking advantage of opportunity. It's just understanding how you can take advantage of those opportunities. You mentioned marry the house, date the rate. That's true. However, there's an inverse of that. There are some scenarios where the rate is more important. I want to marry that rate forever, or at least for 30 years, and the house might be average. But because it's a great rate, it actually locks in a really good deal. So I brought a case study of a deal that I recently did. We do creative financing classes once a year in our Cash Flow Breakfast Clubs. We cover the vast majority of creative financing in those classes. And excuse me, I think my creative financing class is in a couple of weeks in Ashburn. You guys are doing that next month as well, correct?
Mine's next week. So if you guys want to fly,
look at that. All right. So you guys
want to fly, or you guys want to drive here to beautiful North Carolina,
we'll visit happy to have you. Charlotte, and they'll be covering that. So they'll cover it before I cover it, but I'll be covering it in the second week of September. and we cover, novations, we cover seller financing. So we're not going to cover that today. We cover subject to, we cover wraps, we cover lease options, but a few of them just kind of get some honorable mentions. But I want to cover something that we don't normally cover in depth at our classes. So subject to, we do cover. Subject to, for those of you who have not been through one of those classes yet, it's where you can buy a property subject to the existing mortgage. And so the property you're buying for X dollars, let's say $400,000, but you can come up with an arrangement where you take over their mortgage payments. Instead of paying off the mortgage, you take it over. Now, there's a whole legal structure of how to do this correctly or the most safest possible. We're not going to cover that today. That's in the classes that we discussed that. However, that allows you to buy, let's say you're buying a $400,000 property, and the mortgage with a 7.5% interest rate with today's rates on DSCR, let's say you are cash flowing negative $500 because the mortgage is now, $5,000 or whatever it's going to be, and the rent's not enough to justify that. However, you work out an arrangement where the seller's okay with you taking it over subject to, and they happen to have a 3% interest rate, and that mortgage payment is like almost half, right? And so now you're cash flowing $1,000 because of that, right? So it definitely is important to understand that. Many investors out there don't even understand this topic in of itself. Most real estate agents don't understand it, and I would say the vast majority of sellers don't even know what it is, right? So it's a lot of education on your part, learning what that is, and then being able to educate it to your agent, or if you're going to go direct to seller off market, being able to understand how it could be a win-win. Like, I never do a subject to deal unless it's a win-win for me and the seller. And so we'll go through some of those scenarios here. We did buy subject to, but then we're going to talk about the property. The property wasn't a great rental. It doesn't meet my normal criteria. But I had this, started this relationship, the numbers online weren't exactly what the numbers were on the tools that I use. And so it didn't pencil out like I'd normally want. But let's cover what we actually did in those scenarios. So this was, oops. All right. Lease option. So this gets an honorable mention in our classes, but we never spend a lot of time on this. But I see this as, I've been doing more and more of these, but I see this as a way you can definitely help out somebody. But you can make a deal that might not pencil. There's more moving parts involved in this, but this is a deal that should not have made me money, that we made money on, and we're going to make hopefully a lot of money on at some point as well. This is in Texas. It's a 3-bed, 2-bath, basic single family home. Nice, only about 6 years old or something like that. It was turnkey. Didn't need to do anything. It's beautiful. Homeowner bought it. They got relocated. They moved out clean, and they're kind of for a couple months weighing their options. Are they going to sell it? Are they going to rent it? They decided they don't want to be a landlord. And I talking to the seller directly off market. They don't want to be a landlord. I spent some time talking to them. Hey, you can be a landlord. It's not that hard, but for some people, it's just not something that's in the cards for them. They don't want to do that. And then so they looked at the option to sell it on the market, and roughly it's around 250, maybe 255 value, somewhere in there. Their market slowed down a little bit, like many markets did. They probably bought, towards the peak, so they didn't pay off much equity. So they have $225,000 mortgage there, and it's a $247,000 sales price is what we ended up buying it at. Their mortgage, however, was a 3.5% interest rate. And so their current mortgage, PITI, principal, interest, taxes, and insurance, is $1,700. If I had to buy that today at a 7.5% rate, that would be closer to $2,500, $2,600, $2,700, depending on the rate that we qualify for. The rent is only $2,000, right? So 25, 26, 27 clearly doesn't matter. The rent, however, is so close to this PITI. We're going to say, why would Omni buy that? That's very low margin there. We'll walk you through what that scenario is. But what ended up happening was I had to pay $27,000 at closing for this. So much less than a 20% down on a normal property that I'd normally buy. And that was the cash difference between the purchase price and the mortgage that I'm taking over subject to. Roughly 22,000 went to the seller. The rest was closing costs. All right, it was off market. There was no commissions. We had a transaction coordinator, but pretty low cost there. So I paid for all the closing costs. The sellers end up getting 22. So the number one thing people ask when I do subject to, or anyone does subject to, is why would anyone do that? Why would someone sell me their property? I own the property, but they still have the mortgage in their name. Sounds risky. There's a lot of things to kind of consider, but let's talk through what the seller scenario was here. So the seller scenario, I referred an agent. They looked at on the market options, and basically on the market options, the agent saying, hey, on the best case scenario, you're going to sell this in 2 months. It might be 4 months. It might be 6 months. And that's mortgage payment of almost $2,000 a month. So there's carrying costs because they don't live there anymore. There's commissions, there's closing costs, there's the seller side closing costs. So they would basically, although it wasn't like a true short sale scenario, it's like a short sale. They would have to bring $5,000 to $12,000 to the table, depending on how long it took. That included their carrying costs as well, right? So we're talking about money out of pocket to sell your home. That's never a fun scenario, but they were in a situation where they had to move. They didn't think they're going to be moving. They just didn't hold it long enough. If they hold this for another 10, 15 years, they'll probably have a whole bunch of equity, a whole bunch of profit. And I told them that. And they said they just don't want to do that. They want to exit. Where my scenario, we were able to close in less than a week. Zero carrying costs for them. From the moment we had a conversation till close, they didn't make any more payments. I took care of everything. No commissions, repairs, showings, none of that. That 3.5% loan stays on the books. I took over the payments of it. In our classes, we talk more about the mechanism of how we do that. But for simplicity, I took over the payments. The mortgage stays in their name. The title comes into my name or one of my LLC's name. So scenario number one, listed on the MLS, find a regular buyer, sell it with a conventional loan. They would have to bring $5,000 to $12,000 to the table. Scenario number two, they walked away with $22,000. So that's a huge difference. That's a $27,000 to $34,000 swing in their favor. That's why they want to do the subject to. That's why it made sense for them. And this is something that they didn't really understand until I explained it to them. We looked at all other options, but this is the only option that actually made sense for both of us. I could have bought it in another way, but it would not make sense for me at all. But this allowed them to save money and actually make money at closing. So ultimately, they're extremely happy. So why this didn't really work as a buy it and hold rental. So why would I actually buy this? Because if we take a look at market rent, right? A lot of times you see things for sale, $2,000 rent, $1,700 mortgage. That's a $300 spread. You're going to make $300 a month. We know that's not true. You're going to have to hire a property manager. I usually pay somewhere between 8 to 10% for a good property manager. So you set aside 10%, that's $200. And it's insane to not set aside repairs, reserves for vacancy, repairs, CapEx, and things like that. So at a minimum, 10% maybe setting aside in this scenario, although the property looks great, tenants in there for a couple of years, you're going to have to clean it up. You're going to have to repair it, right? So you want to set aside every single month there. So really, where most people are saying that's a $300 or $280 cash flow profit, I would be losing $112 a month, which is not great. What I normally do in those scenarios is, can I change the strategy? Can I do short-term rentals? Although that market does allow short-term rentals, this neighborhood did not look like it would give me the return needed as a short-term rental. Then I look at co-living. If it has the right layout, the neighborhood would justify co-living. The layout was not conducive for me to add enough rooms for this to make sense. So co-living wasn't an option. And so once again, it's negative as a long-term rental, and long-term rental was really the only real option for this. And I still bought it. So let's see why I bought it. So here's what we did. I knew when I bought this, the only thing I would do is accept the lease option. I would not accept anything else. I only looked for a buyer tenant. So not a regular tenant, but someone that wanted to be a buyer that couldn't at right now for whatever reason, whether the interest rates are too high, so they can't qualify for that amount. Sometimes they don't have enough down. Sometimes they don't have the right credit. Sometimes they don't have enough job history. This particular buyer had a short sale. So he was a homeowner, understood the value of a homeowner. This tenant buyer that I found, had a short sale several years ago, and realistically 1 to 2 years away from them actually being able to buy again. That combined with our high interest rates would take their payment over what they would be comfortable. They were comfortable at 25, 26. Their payment would be higher than that, or it would force them to buy a lesser property, right? So they're getting a deal, $2,000 rent, but we're doing lease option where they have the option to buy, and I'll show you what the economics look like that in those scenarios. So they had, I still underwrote them, or still made sure that they were a quality tenant, but also I want to make sure, can this person purchase in 2 years? Yep. Can they get this mortgage, or do they have a high likelihood of being able to get this mortgage? There's some people that will do lease options. They'll take a fee, and with knowing that that person has no chance in the future to get that mortgage, which I don't think is honest. So anytime we do a lease option, we want to say, okay, person has a reasonable chance of being able to get this mortgage by the end of this term, and maybe you're willing to extend with them. I usually do extensions if they can't do it, but 2-year term in most of my scenarios. So the lease option, we came up with 2 prices. We basically factored in a 9 to 10% appreciation. I got it slightly under market, but in 9 to 10% appreciation per year for the next 2 years. And that turned it to $291,000. So basically at the end of 2 years, he agreed, he's paying me a fee, I'll share what that is, of $291,000. He can buy it, he'll lock it in. The market goes up over that, he locks it in at 291. It's a little bit under that. He still can buy it. He just needs to bring more to the table to be able to buy that, right? So 291 if you went and got a conventional loan, or if I did a wrap, I have the mortgage in place that doesn't balloon. It has another 24 years left on this mortgage. So if I did a wrap, I was going to give him a 4.75% rate if he put a larger down payment, which is 30% down. Right? And we'll walk through what those numbers look like there. So he was happy with both of those options. Sometimes I give them one option. Sometimes I give them 2 options. Like, for example, if the subject to loan or seller financing loan that you bought it on, if that's how you bought it, if it's ballooning, then you're not going to be able to allow him to take that over, because his will balloon as well, right? This one doesn't balloon. I can keep this, forever if I wanted to. But I gave him that option because if the rates don't come back down like he's hoping, then he can pay more for a lower rate, and he can run those numbers to see if that's a better deal for him. And so those are the scenarios. So here is what happened in the span of about 2 weeks. So I put in $27,000. That was what was called my entry fee for closing. That's all the cash out of pocket. That's the down payment that went to the seller and the closing cost. So this one cost me $27,000. And I got several applicants, and I don't advertise X% down or anything like that. I get the applicants in, make sure they're qualified, and I say, what's the most you can put down? If you want to secure this, what's the most you can put down as your option fee, which will go towards your down payment when you do buy this? And he happened to say $20,000, right? Some people will come in, I got $1,000. Some people come in and I've had someone put like $80,000 down as an option fee before. They're so confident they're going to buy this because this is non-refundable for them, right? This is my payment for not selling this to anyone else for the next 2 years. I don't have the legal right to sell this to anyone else except for this person. He controls this property for the next 2 years. And so that's the option fee. If he does buy it, it goes towards the down payment. If he decides, you know what, no, I don't want it anymore, that's compensation to the seller or the landlord in that scenario. So I have $7,000 left in this deal out of pocket, right? So that's my actual investment after 2 weeks of this, $7,000. Sometimes you can get all of it back. Sometimes it's a huge fee up front that you're paying and it's not getting it all back. Sometimes you might leave $50,000 or $100,000 in the deal, and you work with those numbers to kind of see, is that something that you're comfortable with, right? So I analyze best case scenario. Do I get it all back? Then it's a great scenario. Or do I leave $15,000 in a deal? What if I only found someone that's willing to put a $5,000 option fee, right? So I ran all those scenarios and I had to be comfortable with them. But in this price point, for a serious buyer that's very confident that they're going to do it, somewhere close to 10 to 15% down is not unheard of. They don't always want to do that, but if they know that they're in competition, they're going to say, yeah, I can put this down. Like, here's what I want. So that's what it ended up being. What we also do, we set it at market rate. $2,000 was market rate. So his rent is $2,000. So he's not paying an inflated rent. However, we say, in addition to the rent, how much more can you send us each month to go towards your down payment and to increase your deposit? It's not required, but this is still in the application phase. We ask every single person how much down up front, how much more can you afford to pay? And he's like, I was ready to pay $2,600. So I could easily put another $500 a month above and beyond rent. And knowing that every penny of that $500 goes towards his deposit. So I'm getting the $2,000 rent that's covering my expenses. He's sending me another $500 every single month. And that goes towards adding to his $20,000 that he already gave me, right? Not everyone does this, and not every buyer tenant is in a position where this actually makes sense. But whenever possible, especially on like turnkey newer homes, I basically write into my lease option that they take care of everything. So I don't want this to be like a normal landlord relationship. I want you to feel like you own this home, although technically you don't own it yet. You own the rights to this, meaning you're taking care of everything. Now, if the roof's only a handful of years old, everything's fairly new. So there's less likelihood of something like that happening. If you want to get a home warranty, you can do that. But for you to qualify, you're going to take care of all the maintenance in this. And I have many lease option tenant buyers that have agreed to that. Sometimes on larger price point homes or older homes, you might come up to everything under a certain dollar amount. Everything under $5,000, they're taking care of. Anything big, then that might be the responsibility of me, right? So that's all negotiable. But in this scenario, he agreed to take care of everything. And so once again, over 24 months, with his option of $20,000 and his $500 more per month for 24 months, he's giving me $32,000 above and beyond rent that's going towards his down payment. He's making it easier to have a larger down payment at some point in the future. Also, I don't need a property manager because I'm not treating him like a normal tenant in this scenario. I would not have to hire a property manager because if something breaks, he doesn't call the property manager. He takes care of it. He needs to keep me updated. He needs to give me receipts just to make sure in the clause he's using a licensed, reputable professional, but he doesn't need me to, he doesn't call me because we're not fixing the toilet. We're not doing any of that. They're taking care of that. So no reserves, no repair risk. There's zero vacancy risk because of the big deposit, that more than covers it as well. So now where those had slim margins that took it to a negative, now we're at least in a positive. So we are positive cash flow, $288 per month now. Still not great, but let's work through the numbers. So previously I would be losing in a normal rental scenario $100 a month. Not great. Now we're positive almost $300 a month, which is $3,454 a year. All of that comes to me because there's no repairs, there's no reserves, there's none of that. There's no property management. Still not a whole ton. However, if you remember, I only left $7,000 in this deal. So we look at $3,456 per year divided by the $7,000 investment. That's almost a 50% return on a small dollar amount, but pretty good return, right? So I made the return better than normal return where it made sense for me. This is only based on the $2,000 a month rent. I don't count the $500 as actual income coming in yet, because that is going to be his down payment. If he doesn't execute, that becomes profit at some point, but that becomes your gain down the road if and when the sale is executed. I know this is a lot, guys. So if you guys have questions, type it in, and we'll give a few minutes at the end for questions and answers as well, because we're tying in a few strategies here. All right. So at the end of 2 years, if he buys with a conventional loan, let's say rates come down, he's happy with those rates, and as an owner occupant, he could put 5% down, he could put 10% down. He already by this point would have given me $32,000 deposit and extra. That's more than 10%. So he would literally be able to buy this with no money, additional money out of pocket. Makes it easy for him to qualify. So we're not worrying about the funds he's going to come up with in the future. He just needs to qualify, make sure his credit, his short sale scenario is all taken care of. And the rate at that time is enough for him to get a mortgage that he's comfortable with, right? If that's the case, he's buying it for $291 plus minus the $247 that I purchased this for, plus the positive cash flow that I'm getting for that 2-year period. I'm making a $50,000 profit, which is a 727% return on that $7,000. Not bad. I would tell you most deals I do don't have a 727% return. But he closes. Once again, what I'm happy with this, whenever I do this, I do this, I think of these differently. When I buy a rental, I want to keep that rental forever. Like, I don't want to sell it. But when I buy a scenario like this, where I know from the beginning it's going to be a lease option, I hope they do buy it. Sometimes they do, sometimes they don't. Then I put someone else in there. But I hope they do buy it. I can make a return, a short-term return. I'm not getting forever cash flow in many of these scenarios, but I'm helping someone buy that maybe couldn't buy previously, and I'm still making sure I'm getting a return as well. But once again, he doesn't need to bring any down payment in that scenario. He might actually get some cash back in that scenario, which would be great. If he decides he wants to do seller financing, the rates skyrocket. We're at 9% rate. When he's trying to refinance, he's like, I don't want a 9% loan. I'm willing to overpay. $320, in my opinion, will be over the valuation. It'll probably be, based on our best estimate, best case scenario, worth $291. That's how we came up with that number, $320. So knowingly overpay, but he's locking in a lower rate at that scenario, and he doesn't actually have to qualify at that point, right? So maybe his credit issues are still an issue for him. So if we factor in minus $247, what I bought it for, plus the 2 years of profit on his rents coming in, that's almost an $80,000 profit for me in that 2-year period. Once again, on my $7,000 investment, that's almost 1,000% return. Once again, 1,000% returns are not normal and not realistic in many scenarios, but if you get creative enough, you can make them work, right? So here's what would change for him, though. He would need to bring 30% down, because I want to do seller financing on the existing mortgage, which would be $225, maybe $222 at that time, and everything else he's going to do a down payment. So he would have to bring $96,000. He already paid $32,000. So he would have to come up with $64,000. So if that's his strategy, then for the next 2 years, he's setting aside and saving up $64,000, and he's able to do that. I will say, in many scenarios, I'm willing to seller finance part of that equity, upwards of 50% of that equity. So if he says, hey, I can come up with another $32,000, and I seller finance for X percent for a 5-year period or 10-year period, that's something that I would normally consider. And I've done that multiple times before. What I love about this, though, if he does this strategy, one, I make more money. He gets a great rate, because his payment is going to be that $1,700 payment that I'm making right now, which is great, versus a $2,700 or $30,000 payment at a high interest rate for $320,000, right? So he's getting like almost half the payment. So it's great for him. He needs to come up with slightly more out of pocket if he can do that. But I'm making a spread. I have a 3.5% mortgage. He's getting a 4.75% mortgage from me. That's called a wrap. So I took over the mortgage subject to, and I hired an attorney to wrap that mortgage. And basically, I become his seller financing mortgage. He's paying me separately. He's doing nothing with the sub 2 mortgage. I'm still responsible to pay for the sub 2 mortgage, right? So it doesn't change my obligation. If he stops paying me, I still need to pay that sub 2 mortgage and for the cost of the money. But I'm making a 1.25% spread on that rate of the $320,000 mortgage there. So anyways, that's kind of the over end of the numbers there. So once again, 3 parties win. The seller absolutely won. For them to sell this in any other way, they were losing money. It didn't make sense for them. They walked away with $22,000. They've sent me thank you messages since then, because the alternative was I have to pay to sell my home, and they were not happy about that. And they were just stressing out. They had a vacant property, and they're just having a hard time deciding what they wanted to do with it. The tenant buyer is going to win, because he's locking in a property in a neighborhood that he wants to buy, in an area that he wants to buy. He has a great job. He has money already. The $20,000 he gave me is not all of his savings. He had even more above and beyond that, because we went back and forth between $20,000 and $25,000. But he's confident he's going to get himself in a position to buy, and he has 2 options to buy in the future. He had no idea about seller financing until I explained it to him, the wrap scenario. So the idea for him to worry about interest rates, I don't know if it's going to be 5% or 8% in 2 years. He's hoping for the lower, but if not, he has a lower than 5% rate that he will be able to take advantage of at some point in the future, if that's the option. So once again, $32,000 down payment. It forces him to be fiscally responsible because he's not putting this in a savings account. He's giving it to me. Now, they don't have to do that, but when they know that there's 7 applicants, right? And we tell everyone, here are the 3 things. One, we're only going to go with someone that's qualified, but how much you put down and how much over rent you pay will be a deciding factor on who we choose. So we let him know that. And so clearly he was trying to get the property, him saying $500 over. We ran the numbers. He was clearly qualified for that based on his income. And so it makes sense. So he's happy as a buyer. He sent me some thank you messages, and me as the investor, obviously, we've already minimized our risk, $7,000 left in the deal, very, very low risk. If he doesn't close, that would suck. I would work with him to try to make that. But let's say something happens, he moves, he says, I can't buy in this area anymore. I'm being relocated. That would suck. But we would clean up the home and we would find a new lease option buyer. And we'd do the same thing 2 years with that new lease option buyer. I've had to do that. I've had to go through a couple lease options, at some point because their plans change. However, someone doesn't become a lease option buyer unless they are committed to buying. And it's often a previous homeowner who says, okay, I want to get back into home ownership, but I'm not in a position to do that now. So we're making a good return. Just on the cash flow, making a good return. And obviously it's almost like a flip profit in 2 years, but we put $0 of money or effort into fixing. Literally, we did nothing. It was professionally cleaned when we took over, and we literally just, all right, let's find that lease option. So that's that deal. The deal was never the problem. And what we want to do is give you guys various tools to overcome multiple scenarios. I've said this multiple times. You can invest in any market. You can make almost any property make sense. You just need to know enough strategies to be creative to make those certain deals make sense. Because on paper, 99% of investors will look at this. Even me, I'm like, I don't know if I want that deal. But we already built this relationship, and I felt for them, and I realized someone needed to do a subject to for that these sellers to make it work. But if I knew subject to but didn't know anything about the lease option, I would have passed on this because they're like, this is not a charity for me. I can't help you out with a subject to and lose several $100s a month. That's not how I run my business. But the lease option is what changed that for me. So bad rental is not a bad deal if you understand the creative side of things. And shifting the expenses. Number 2, the option deposit is a return of capital. And then the shift of expenses shifts the risk as well. And then once again, price the exit, not just the entry. So how much you put and leave in the deal versus how soon can you get it back. We talk about the velocity of money when we do the burst strategy. This is almost like a burst strategy because I'm only leaving $7,000 in the deal, still getting cash flow, and then getting a payout even above and beyond that at some point. So think of this as a lazy burr. There's a lot of work to be done administratively, legally, and advertising wise. But there's no work to be done in terms of renovation like a normal burr. Awesome. I saw a couple questions come through, but that's my slides there. I know you had a summary slide, Carlos, on the lease option itself. Let's add that up. But let's see what questions we come here. All right. How did you find the buyer tenant? Do you use Realtor, Zillow, or Facebook? Yeah, really good question. Facebook and Zillow, Realtor.com, anywhere that you can put up those rental listings, put it on as a rental listing is where you would do that. If it's a much slower market and you try that and you already have an agent, then okay, you might hire an agent. There's a cost to that. Hire an agent to put it on the MLS as well. But you can get to Zillow without going to the MLS. You can get to a lot of sites now without going to the MLS. So I try that first. Sometimes when I'm under contract and I'm ready to close, I have my team put up the listing and say, here's our property, here's for sale, here's for rent. But in the front, their very first words are, lease option only. Meaning we will not accept the regular tenant. A regular tenant does not make sense for this deal. A regular tenant would lose us money. So lease option only. And sometimes you get questions, what is the lease option? We explain it to them, or we still get people saying, I really want to rent this, but I don't want the lease option. Say thank you, but that's not the right fit for us because we don't want to leave that money in the deal. But this person came off of Zillow, I believe. But yeah, all of the above is where you, just like a normal rental, you put it out like a normal rental. You'll just make sure that the wording and the description covers and says lease option only. Good question.
How do you find the seller? Like you're in, and I mentioned this because a lot of people want to invest in their market, and their market is extremely competitive, pricey. You are in Virginia, obviously, and you are in living in South Florida. So and the property is in Texas. So did you ever went to see the property? I haven't heard you flying to Texas and recently.
I've not been to the property. I know that market. My grandparents, for a short bit, lived in Lubbock, Texas.
Okay.
So I know that market, but it's one of many markets that I own properties in already. And so when this one came from one of my team members. We do obviously we work with agents, we work with wholesalers, and then there are certain communities where we scan and we look for off-market deals, and we do direct-to-seller communication. We don't do a whole ton of direct-to-seller communication. This one actually did come off of direct-to-seller communication. PropStream, there's other tools out there. So we teach once a year off-market deal finding. But lock in on your market or markets. I have many markets, but this just happens to be a market that I'm already comfortable in. If this was a brand new market for me, it'd be a little bit more difficult. I usually want to make sure I have my team in there, make sure I have everything already set up in place in that neighborhood. But in a lease option scenario where I don't need the property manager and I knew that this is the only thing I was going to do with it. Another thing, I factor in amount of reserves to cover several months of carrying costs, and I factor that in as part of my down payment. So I was prepared to put upwards of $35,000 down to have 3 months of down payments in this scenario, 3 months of mortgage costs, because maybe it takes longer. Maybe you get a lot of rental inquiries, but it takes longer to find a lease option. That being said, it's actually pretty exciting for many tenants, even if they're not qualified. Pretty exciting for many tenants to think about. Man, you think about a regular tenant. I didn't even think about buying, but if you're saying that part of this rent could help me to buy this home, like this is a nice home in a nice neighborhood, and they might have been in a position where they thought that wasn't achievable for them. So we do get a lot of inquiries. Some of them are just questions about what it is. I saw a question here: how easy or difficult is it to explain this strategy to the tenant and buyer if they're not into real estate investing? This is probably one of the easier strategies, because I think many people have heard of the concept rent to own, which is what a lease option is, rent to own. And if not, then usually there's a little blurb in there about what this is. Part of your rent, your deposit goes towards your down payment. So we try to put in a little bit of what that actually means. But I'm okay fielding questions or having my team field questions of what does this actually mean. But we don't say 10% down. We don't say X percent interest rate. We don't say what price we're going to sell it at in the future. We just say, are you interested? We're going to be renting this for $2,000, which is market rent. But then once we get the applications through, or we get in-depth conversation, we explain, here's what we are going to be looking for. We don't have a standard deposit we want, but you're going to be competing with other people that want this. And so the person who can put the highest deposit down and the most amount of rent above and beyond the normal rent down will have a higher chance of getting it if they're qualified. Understanding all of those things go to your benefit if you're truly committed to buying this property.
Sure, makes a lot of sense. So again, this is an interactive part. If you have any questions, please write it down. In the meantime, we have like a summary version here. Obviously, this is a different deal than one that you presented. Obviously, yours was a lot better.
Yeah, you put together this, but yeah, walk us through some of those highlights. A lot of it came in here as well, but this just I like this slide that you put together, just kind of the mechanics of a lease option there. And maybe I don't know if there's a way. Oh, if you guys after you're done, you guys can go back and see these slides as well. So we don't have a lot of time on this. We only have a few more minutes. But anything that
Sure.
stand out on this that you want to cover, Carlos?
Well, no, you did it great. I mean, just how it works is basically, control the property. It's a lower risk. And I love what you mentioned, because other people complain is that in this market it's hard to make deals, but obviously you mentioned before we didn't do much. Yeah, you did a lot. I mean, yeah, you did all the preparation, everything to be able to explain it properly. And just here is just like the benefits, be able to build equity in a property that might not be ready to, like, in a case like I say, a lot of investors, myself included, when a property that is distressed in terms of like, well, how can I add value? And instead of like, okay, property is already turnkey, but I'm gonna figure out to strategize it this way. So that's one of the benefits that I like there. Looking at the price and the terms, I think you explained that great, and just for appreciation in terms like of the negotiation that you did. So as a way to create wealth, definitely. It's lower. You mentioned fix and flip, something that we do. It's a lot of higher risk, especially how competitive it is. So when someone sees something like this, like, okay, it's a no-brainer. Obviously, you have to be able to explain it properly and just get the right buyer and the right seller and the right buyer. I mean, there is always like, I'm not saying it's impossible to do, but it's always like a formula to be able to get the result. That's what I'm trying to
Yeah,
say.
it's like I said, the BRRRR strategy, we teach that once a year. It's one of my favorite strategies: buy, rehab, rent, refinance, repeat. Amazing strategy, harder and harder to do with the higher interest rates, because the exit on that is a refinance, right? So this is like a BRRRR type of solution that's primarily made possible because of our tough interest rates. Like, once interest rates become better, this becomes less appealing for many people, meaning many people won't do subject to, or they won't do seller financing when the interest rates are just low, because it just doesn't make a lot of sense. So any market we get into, whatever is difficult, always try to look at what are the opportunities or the unique opportunities that difficulty creates, where you can go out and try to stand alone. In our class, like, there's other case studies that I just realized was way too long, so I took them out. But like, I've done a lease option where we actually bought it on a lease option. They weren't ready to sell it. We went to someone that is renting their property, and it was sitting on the market for a while. And we said, well, would you be interested in selling this property? And then what about a lease option scenario? And we were able to get a lease option with a low deposit to them. And then we were able to turn around and do a lease option to someone else with a higher deposit to someone else at an elevated rent as well. So basically costing nothing out of pocket in this lease scenario. I can execute the option to buy it within a certain period of time, or assign that to someone else if it's assignable. So there's so many things that you can do. It's all about just understanding the tools that we have in our tool belt. So hopefully this is helpful, guys.
Something really quick before we finish it, just to give you perspective. You mentioned like one kind of buyer that would be ideal for this, someone that is going through like a short sell scenario, but that's not the only one. It's a lot, like we talk about a lot of distressed sellers, but we have a lot of distressed buyers. People that file like bankruptcy, people have a lot of
Yeah, I
debt.
mean, to be honest, so many buyers are not distressed right
So,
now. They just, like, it doesn't make sense with the interest rates, or at least they don't feel
totally,
it makes
yes.
sense with the interest rates, right? Because they got qualified at a 4.5% rate, and they were a little bit nervous. They never bought 4.5%, and then it went up to 5, and like, oh, let's wait till it comes down. Then it went up to 6, and now when it went up to 7, and they're waiting for it to come down, and now they're like, man, I qualified for $450,000 before, and now I qualify for $300,000, which means they got to go from this to this, and that's hard for people to mentally make that change in their mind. Or my payment was going to be $2,000, now it's going to be $3,000. That's hard, right? They're having this regret, this remorse for not taking action, but it's leading them to not take more action. So there's actually way more buyers out there now that fall into this category, that are just normal buyers with zero distress, other than they missed their opportunity in their mind. And if you can provide them with the opportunity to potentially lock something in now, a price now, with a future interest rate, or maybe even a lower interest rate if you're buying it on creative financing, you're definitely helping someone out that might never buy, because they just come up with a scenario where I'll keep waiting. And as Victoria mentioned, they wait for that interest rate to drop, but now the prices are skyrocketing after that.
Or market change, it makes no sense for them. They're gonna be able to buy something better. Okay, go ahead.
So Tanya asked, how did I determine the amount that goes to the seller? So the seller, when I bought the property, I think is what she's asking. We determined a purchase price that I was comfortable, which was $247, I believe, and the mortgage was $225. And so the difference between $225 and $247 was $22,000. I paid the closing costs. So I said, hey, I will make sure you get $22,000 at closing. And they said, that's amazing. I talked to agents. There's no way I'm supposed to get $22,000. I'm happy with this. And I went through this. Here's what it means. Like, we're literally partners. Like, I own the property, you own the mortgage, but I'm responsible for paying the mortgage. And I'm going to make sure I'll verify every single month, so you see that I'm doing it right. So it becomes a partnership. And, and there's a discussion in our Cash Flow Breakfast Clubs on how to have that conversation with the seller, which is beyond what we're covering today. But yeah, they got that $22,000 from if you're talking about from the buyer side or the buyer tenant side. Literally, it could have been $5,000, it could have been $10,000, it could have been $30,000. Someone could have came in and offered way more, because you'll be surprised. There's people sitting on cash out there, and it's not always someone that doesn't have the down payment. A lot of people think it's a down payment holding people up. Often it is they don't want to pay the interest rates or timing or job stability or whatever it may be. But great questions. Awesome. I think that's it. I think we ran over time here. So any questions, you can reach out to Carlos or myself. Happy to hop on a call. Carlos, I'll send you these. You can cover this in your creative financing class next week. I'll go over this case study along with all other creative financing strategies at my Cash Flow Breakfast Club in Ashburn in a couple of weeks on the 8th. But I'm glad that you guys are able to join us today. Thank you all. Thank you, Carlos, for hosting as usual. Next month, mark your calendars, the last Wednesday of the month, we will be talking about the sky falling, the AI bubble, and what I'm doing about it, investing with retirement accounts and strategies and things like that. So we'll bring on a guest presenter. Should be a great conversation. Thanks, everyone.
Have an amazing night. God bless you. Bye-bye.